Hi, everybody. I just decided to make a video because certain things I could just say, but you actually have to actually see. And what we've got here is a picture of, Yahoo Finance. So you can actually do this yourself, is the reality. But I just wanted to give you some insight on some things that, you know, the things that keep me up at night these days. These days, I mean, there's always something, but these days everything's dominated here by financial markets, and here you have it. This is the S&P 500 for those people who don't know. If I had used a single statistic on how the US equity market is faring, it is SPY. SPY. You see here in my, hopefully my arrow is going around in a corner over here, SPY, right? And this graph is the year to date graph of it. Okay, it started here at this number here, and it's down about 8% for the year. Now, I start here in isolation, and it's very important to know this, right? Markets don't move in isolation. One stock doesn't move without something else. But here is the gravitational force. This is the Death Star, if you will. This is the biggest one. This is the center of gravity when we are talking about the US stock market. Okay. So, generally speaking, this goes up and down, and you can see it here. If I take a look at the 1 year chart, all I have to do is click, and you'll see a couple of notable things. Number one is here. Here's where we are today, which is basically equivalent. Okay, if you look back in time, this number where we are today, you can look over to the left, and basically what you get to is this peak here, June 20th, 2019. In other words, this is glasses half empty, glasses half full, right? In other words, it tells you that you've also made zero money since, for 6 months, 7 months, which is okay, except for then you have to ask yourself, was it worth the risk? That I'm not going to determine that for you. Certainly not on this video. No way. Okay. Because that's an individual situation. You may have needed the money to pay bills. Okay. Then this candidly is probably not worth the risk. Why? Because you can see over here. I'll try to make my head smaller. I can't make my head smaller. I can make the picture smaller. Anyway, you can see, this is a fairly substantial, notable drop, the fastest, steepest drop, in history so far. Anyway, I'm not here to determine. I'm not here to determine for you, not for these purposes, not for this video's purposes, whether or not this was worth it. That's up for you to decide. So you saw in the letters or in the newsletter, I've been making comments about larger markets not buying it. And, you go back to the newsletter, you can see it there. And what I'm going to do here is I'm going to make some comparisons. And here's what I do. Here's actually what I end up doing. So let's just take a look at this. This is another ETF, and it's called AG. And this is the consolidated or the overall bond market, meaning government bonds as well as treasury bonds. Okay, as well as treasuries. So you can see over the year to date, you can see something actually quite dramatically different. I'm no good at moving these windows around. Another excuse to be smaller. Okay. You can see down here in the lower right-hand corner, this number that just showed up in blue, minus 8.8%. You can see the bond market, plus 3, what does this say over there? 3.1%. So in other words, what has happened here is the bond market has vastly outperformed the stock market by 11% for the year. Now, this just gives you an overall picture of where we've been for the past 2 months. But let's take a look what happened over the last few days. And you can see it. A little change here. Don't worry, this will come up. And now you see the bond market has not dropped. It hasn't really risen, interestingly. We'll get to that. We'll get to that. It is the source of concern, actually. But the stock market down, and notably down. So let's take another time frame. And here's the time frame I'm going to show you. Okay. So a month ago or so, in February, and then what happens is coronavirus headline first came out. And then things said, okay, well, it's stabilized, etc. Which I was not necessarily a buyer, but let's just presume that was true. Let's presume that was true. Okay, that you believe the headlines. Stocks ramped higher. You can see this blue line. Bonds did not go lower. And this was a very important aspect to me. This is a very, very important telling thing to me, because the way that big money works, I'm not talking about your stock picker and your little mutual fund over here. A single mutual fund is like, that's a flea on a dog. No. I'm talking about the big amounts of money are moved in foreign exchange and the fixed income market. They are many, many times bigger than the equity market. My clients, they're tired of me telling you this. Okay, my active clients. Anyway, you can see it here. When stocks go higher, you would have normally thought people have sold bonds to buy stocks. Okay? If this were real, if this whole increase were real, right? And it's real because prices went higher. That doesn't mean that full amounts of money was being reallocated into stocks. And you need to understand that there's a critical difference here between those two. So simply put, what happened is stocks went higher, bonds did not go lower. In other words, bonds weren't buying this story. Okay, that's number one. When I added, and then I said, okay, well, I could just see two pieces of data. Do I make that a sweeping generalization? Which is a fair question. Let's just take another. Let's add another. This here is an ETF which describes utilities, United States utilities, utility stocks in the United States. And we're going to get to this because this is very interesting. I guess maybe only to me, but still interesting. You can see the stocks went higher. And again, much like this purple line, which is fixed income market, US bonds, for this period, utilities did not go lower. And in fact, utilities went higher. Now, why is this important? The reason it's important is because utilities are usually known as probably as the single most defensive sector in the United States. Okay, no matter what, I've got to turn on my electricity bill. I've got to pay my Con Ed bill, right? Detroit Edison bill, Florida Power and Light. Got to pay that bill, right? So the idea that the lights are going to shut off due to my utility failing, it's virtually zero, right? That doesn't mean the stocks do well, but basically what happens is people sell risky stocks to buy defensive stocks. XLU, utilities, pretty much tells you the tale. That also means that when people are buying riskier stuff because they like the risky stocks, the flying stocks, they sell the defensive stocks. They didn't. They simply didn't. So warning flags went up. Warning flags went up. And, so I was quite skeptical, and there were reasons for that skepticism, right? The bond market didn't confirm. Utilities didn't confirm. Okay. So that brings us to today. What makes me worried today, however, is this. You can see it here. Quite dramatically, the 24th, and then especially here on the 25th, 26th, 27th, 28th. Wait a minute, I think yesterday was the 28th. Can't even remember what day it is. I think, yes, the 28th, you could see utilities declining. Why? Why? And it starts to become worrisome. Worrisome. Why? Because given what I've just said, right? Utilities defensive. People, so if you sell risky, you buy less risky within the basket of stocks. Okay? And that's the orderly process, right? I think that tech is going to do better than utilities. So what do? I buy tech, I sell utilities. I buy the high flyers, I sell the, boring stocks, utilities. What happened here? Indiscriminate, disorderly selling. Both sold. And you can see here, pretty much the same angle. And you can see here week to date, if I had the ability to show you a 5-day chart, let's see it. I think I can. And these different programs are, yes, and you can see it. Utilities actually worse than the market as a whole. This is worrisome to me. Why? Because it means that people didn't sell the stock market as a whole in order to buy defensive stocks. They just sold everything. Right? Just sold everything indiscriminately. Why does this matter? Why does this matter? And do we have evidence of this in other places? We do. We do. Let's take a look here. Gold. So persons who are market, watchers, if you will, if you're an armchair portfolio manager, this has been fine, right? In other words, what you've seen here is you'll see year to date, gold done very well. All right, so this is now just the blue line again is the stock market as a whole. Utilities for this as a whole still outperform, but you can see it there. And then gold. Also, again, so the people who buy gold because they're distrusting of, government fiat, if you will, right? Safe haven doesn't have any dividend, doesn't have any interest, right? But you can see people go there purely as safe haven. And you can see it here. That's this kind of salmon colored line. You can see it bumping along and now doing better than stocks year to date. In other words, even though stocks were stabilizing, and then when stocks started to go down, people fled to gold. Clear. That made entire sense, right? I don't like anything, right? Now, the problem with gold, candidly, the problem with gold is that, the market's not big enough, right? I can't buy enough gold to hedge all of my equity exposure. Not possible. Not possible, right? There's a capacity here to these line items. Let's continue on, because again, the disconcerting thing here is, and you can see it over these last 5 days. Let's see here. There's going to be a delay here because, computer takes some time to think. Here it is. And it's not showing. You can see it stable here through the 27th. And then, bam, right in this area here, the 27th, the 28th, steeply lower for gold, down 4%. In other words, stock market continued to go down. Gold went up until that point, as expected. As expected, it went up. Okay? But it is more than alarming to me that stocks went down and gold went down, both, right? Which broke the pattern of stocks down, gold up. This is other evidence of disorderly selling. Why does this matter? It matters because it's evidence. It is potentially evidence of Borrowing investors, people who borrow to invest, have had to pay back the lender. Okay. Who is this? Hedge fund. So basically, you can see basic mechanism to a hedge fund is they borrow money from a lender. Let's say they went to the local bank and borrowed $100. Okay. And they took the $100 to buy Apple stock. Okay. Now the Apple stock is worth 90. They still owe the bank 100. So what did they do? They went to their gold holding that was doing well and sold some of it in order to pay back the bank who has given them a phone call to say, hey, your money has gone from 100 to 90. I need this money back. I need this 10 back to make sure that you can pay back your whole amount. They've got to raise this extra 10. How do they do it? They sell the winners. What did they sell? It's clear here to me. They sold the winners. Who were they? Utilities, gold. Otherwise, if it were orderly, we could have continued to have stocks down, gold up, or stocks down, utilities down, not nearly as dramatically or sharply. We saw over those days, you can see it, like I said, this drop, you can see utilities dropped sharper than the market as a whole. That world shouldn't exist in a down market unless something's disorderly. Okay, unless something's disorderly. Okay, so now you can kind of see where I'm going here, which is when I see these relationships start to break down, I've got a problem. And by I've got a problem, I have a problem with the way that markets are starting to function, right? Minus 10% is dramatic by its speed. You can explain it by program trading, algorithmic trading, right? They start seeing signals, they start knowing things, and then all of a sudden they hit the sell button in huge size. It's not only one program, it's all our other friends who are equally smart running other computers at other locations. They are enough to push down the stock market. That can happen, right? So that's point number one. Okay, that's point number one. I'm going to try to, like I said, I don't have a script here today, so I'm just, psychobabbling in front of you with examples on kind of what, makes me worried. Now, do I think we can continue here? We don't have a crystal ball. We don't have a crystal ball, right? I mean, but let's just take a look backwards. Okay. You're going to hear a lot of news, right? 50-day moving average, 200-day moving average, et cetera, Bollinger Band, Fibonacci retracement, all these, a lot of jargon. Let's just look at something clean and simple. See this congestion area? And I'm going to draw this rectangle here, which I cannot do, right, because I'm on the internet. But anyway, you can see it here. We are testing the top end of this rectangle, which means the bottom end of this rectangle. And until this got resolved, we did not go higher, right? We needed to break this top in order to kind of go higher. Broadly speaking, this is what people are doing, okay? Broadly. It's full of shortcuts, but let's just use that for simplicity's sake. The same thing can be said about this. We're at the top edge of this rectangle. I will not be surprised at all if we touch the bottom end of this triangle. And that price is 283. Okay, to give you an idea, that is $13 on a base of $296, right? That means a good extra 4% to go. And, given these days, you would have said, okay, 4% takes, months. Well, it took, 3 days. Anyway, I'll be looking here. I'll be looking here to see whether or not we challenge this. Or if we just continue to careen higher, we will start higher on Monday, it looks like, right? We'll see overnight, that will dictate things. But on Friday, it looked higher. At Friday, at the end of the market, it looked higher. So it recovered up to here, by the way. We were down here. We were down here. We ended up here due to the last 20 minutes, last hour. Anyway, can we go lower? Yes. The moral of this story is, okay, it's going to snap back. No one said that. And anyone who's telling you, okay, it's going to snap right back, I would just tell you to turn off the TV or hit mute, right? Because there's no guarantee of this, right? If I'm 30 years old and I'm first, saving for retirement, yeah, I'm not blinking here. Matter of fact, you could say I could increase my allocation to riskier stocks here by a smidge, right? However, am I thinking, okay, tomorrow we're going to just snap right back and on we're going to go up here? It's going to take a lot longer to recover from all of the damage of confidence that people had from here to here. Okay. So you're going to have some days that are going to look like plus 1%, plus 2%. That's going to happen. That may even happen with, Monday. Sure. It could happen Tuesday. We've got, political event, et cetera, et cetera. You're going to have other narratives. Leave that to the traders, right? Leave that to the traders. Unless you have a fundamental strategy here that said, I need to be having riskier assets. I need to be in riskier assets. Or you have a overriding reason, right? You can expect lower, a test lower, and not be too worried and not be too jumpy if you see the headlines on a given day that say plus 1 or 2%. We've got 9% over here to make up. 9. Okay. Where do we move to? Okay, so what exists that could be a problem? Okay, so all of a sudden, a new economics finance terms get introduced in the public, and now supply chain now is a thing, and that's true, right? You can see anecdotal evidence, you can hear anecdotal evidence. Costco is out of Diet Coke. Why? Because one of the ingredients is coming of the artificial sweeteners is imported, right? And they're out. Okay, for example. Yes, no question. But and there's no question about the following. And the easy analogy that I use to someone over the phone is, I've canceled my trip to Starbucks, and when this blows over, am I going to go 2, 3, 20 times in order to make up of all the days that I skipped? No, I'm not. Right? And so then the question is, how long this is going to last? We don't know. We don't know. We don't know if this is going to blow over. We don't know if it's going to expand and people are going to stay at home more. We don't know, right? And anyone who purports to know, is trying to tell you a false tale, false confidence. There's also false fear. Don't get me wrong. I'm sure of that. But on the flip side, the people who are saying, okay, we're going to go snap right back, we just find that difficult to believe, other than for trading purposes, which is the very short-term type of matter. Okay. Longer term, my problem here is the following. And let's just see here. Let's see if I see oil. Let's see here, oil. This is oil. And you can see year to date, oil down 25%. Okay. So fine, go to the gas station, refill your tank. Oil has dropped, to get also. Gasoline has definitely dropped, right? I think I saw the other day 210, something like that, a gallon. Okay. While this looks good, the problem it has created is the following, and you'll see it here. ExxonMobil. Is ExxonMobil going bankrupt tomorrow? No, not. But look at its stock. And there are multiple things in play here, right? Oil is not only being, I mean, ExxonMobil is not only being hit by oil itself. There are things like, climate climate change, right? So you've got this carbon emissions matter. But you can see, and let me just change this color. This is ugly. It's the wrong color because I can't see it. There. Exxon is down 27.5% compared to the Dow's 9%. So a couple of important things here. If you're investing in individual line items, this is not that market. The baby gets thrown out with the bathwater, and people have taken risks on individual names, which is a very specific thing. It's a specific risk within the blue line. So there's some Exxon inside here, right? So if you're sure about a line item, you better be really sure. You must have a very specific reason for being investing in a particular company's line item or a particular stock compared to the market as a whole. It means more glory when the market goes up. It should, right? It better, because look at what happened on the way down. Look at what happened on the way down. Okay. Now, this is not the end of the world for Exxon. Like I said, do I think it's going to go bankrupt tomorrow? No, no, that's not on the radar for me. However, more to the point is the fact that the energy sector, right? So ExxonMobil, the high profile name in the United States for the energy sector. In Europe, that would be Royal Dutch Shell. But in the corners of the investing world on energy is a group of companies that basically create partnerships, and they're involved in other speculation around energy. They're called these master limited partnerships. Okay. Now this looks all well and good. What? Let's see. This is the wrong one. Let's just see. No, this is the wrong MLP list because this is MLP for other real estates as well. So give me a moment here. I'm gonna flip over here and then see if we can find something else. Let's see, energy MLP ETF. Can't remember the name. Illyrian, yes, that would do it. Illyrian MLP. So you can actually see how this stuff works, right? And you can, like I said, you can look up the individual names and individual ETFs, the tickers, and do this yourself to some degree. Let's see, indices, MLP index, AMZ, no, infrastructure energy index, AMNA, like a mana. So let's go back here. Let's go AMNA, AMNA. Oops, wrong comparison. AMNA. This index, let's make this pink. Can't even draw the index. I don't know why. Okay, have to go back to the drawing board. Let me just go see if I can find another Energy MLP ETF. AMZA. And you can see I've not started with the script because I'm pretty sure about what it's going to show. And you can see it. Minus 8% here, minus 33% for these MLPs. So these are basically energy MLPs. And what happens is that people build special projects and then they have to pay everything out in dividends. So you can see REITs, for example, are kind of a master limited partnership. Anyway, what's the story here? Here's my problem. Let's see. So ExxonMobil, and then let's do AMZA. Oops, I didn't translate it over here. AMZA. So here it is, AMZA. There it is. Told you I was bad at video. Like I said, I'm not sure why I keep showing my picture. Anyway, you can see it down here, minus 33%. Let's remove oil. So you can see this cluster here, notably worse than the market as a whole. Notably worse. Right? This group here is another 15, no, almost 20% lower than the S&P 500 year to date. And you can see it's not that much better as we expand the time frames. Is it even that much better over a year? You're going to see the answer is no. So energy has been bad for a while and it has continued to be bad and dramatically worse, if anything, right? You can see it here. I'm looking at the angle of these lines in terms of rate of return. You can see it. You know, these angles have not flattened out compared to the blue line. They haven't. The problem here, okay, and this, I don't think, I've not seen this yet. You'll hear it maybe in a little phrase on CNBC, which I have known. But the problem here is these companies that are in this AMZA don't have the resources to pay back debt that Exxon does. They can't pay. If oil continues to decline and it keeps staying or declines further from here, which is possible, and if these companies cannot pay back their debt, the problem that raises is that it is a huge, that sector is a very large component of the fixed income market. And it's a very large component of the junk bond market, which has been almost immune. Almost immune. It is weaker. You can see it. So junk bond market is non-investment grade. So basically companies that are not Apple and Con Ed, you know, I can't even name that many more companies because so many dividends have been cut. But in the past, you would have said that the energy sector and these MLPs were stable because of the fact that they can at least repay their debt due to the high price of oil. Well, if oil has dropped, then these equities have dropped. Now, do I care about the stocks that are sitting in this yellow line? No, I don't. I do not care about it. I have not suggested any single line item certainly within the smaller companies of the energy sector. I would not even suggest it. But my main concern here is more structural, which is that if these companies in yellow all fail, they're going to pull down this purple line. And if they pull down the purple line, then they can affect the bond market as a whole. And then all bets are off. Okay. In other words, what can happen here. And I tell this to people, over, I don't know, when I meet with people socially or talk about these things in public, in which I very rarely do, right? You don't see me sitting at the bar with friends and talking about the direction of financial markets. That's, I'd rather talk about whether Tom Brady's going to resign with the Patriots. But you can see it here, right? Which is the following. The bond market as a whole is AGG. The junk bond market is this purple JNK. They have outperformed stocks notably. And they have outperformed this small group of MLP, of energy MLPs, by an enormous amount. What can happen is if these guys start to fail on their debt, that can pull down the safe havens of yellow and purple. You can see purple's down because purple is down because why? Because stock down or GDP down means people can't pay the electricity bill. They can't pay back their bank for their, revolving line of credit. If that then pulls down junk, in other words, the high yield bond market, now we got a problem. Remember, most of the time when there's a financial calamity, I wouldn't call this 10% a calamity. Worrisome, yes. Calamity, no. Right? Financial crisis occurs when there's a problem in the borrowing and lending mechanism. When something happens in the borrowing and lending mechanism. The financial crisis was because why? Because people couldn't pay back their subprime real estate loans. Period. That's it. Right? Big Short and, overheated prices, et cetera, et cetera. Housing prices could have kept going up if people could have just keep paying for their subprime loan debt. They stopped. They stopped repaying. And then everything else fell. Okay. We don't have that here. We don't have that here. We don't. But these MLPs, in other words, these small energy companies, can pull this purple line down. And then it spread to this one, which has been up for the year. Those start going down. You start getting the same angles down. Then again, remember the very first part of this video, which is now what? 30 minutes? Crazy. Anyway, at the beginning of this video, I was concerned about the angle of, let's just go back to it, right? I'm not concerned necessarily about you. I'm not concerned about Con Ed going bankrupt tomorrow. That's just not on the radar. But I am concerned about the fact that the prices dropped this dramatically in a down market. Shouldn't have looked like this. In much the same way, right? In much the same way, I would have expected. I have expected. So this is not a surprise to me. Not necessarily. In fact, if anything, I would have suggested that this AGG should actually be higher. Should have done better here. I would have a sharper angle higher. Anyway, what you see here is if this salmon colored line starts turning negative at the same time that these others go negative, then we've got a problem that I'm not sure where the bottom is. We can talk about technical now, all those technical analysis, and candidly, most of that technical analysis over the past week was thrown away. People looked for temporary support. The program traders did for sure. Okay. So that's it, right? I'm not going to pick tops and bottoms for you. I'm not going to tell you individual stocks. No, 100% no. Are there ones that are too cheap and too expensive? I'm sure there are. I'm sure there are. today's not that day. Be careful out there. Just have to filter out a very difficult backdrop. Very difficult backdrop. We don't. The unknowns here are not financial, not yet, right? We're trying to. The markets are forward, supposedly forward looking, right? So what's supposed to be happening is markets are discounting. They're trying to predict, okay, what are the actual ripple effects going to look like? The issue is this is very, very different by nature. We had a borrowing and lending matter, a pure borrowing and lending matter before, right? Russian debt default, for example, that's a borrowing and lending matter. IMF crisis in Southeast Asia and in Asia, again, over borrowing matter. Banks can fix that. Central banks can coordinate to fix that. This one is a scientific problem. It's a biological issue. All right. That's enough for me today. I'm Jay. Thanks for watching. If you have questions, send me emails, jae